All right, let's get right into it. JB Chemicals and Pharmaceuticals has just stepped into what might be the biggest chapter in its 50-year history. The KKR era? That's over. The Torrent era has officially begun. So in this explainer, we're going to break down this huge shift, looking at both the bull case and the bear case for what happens next. So, it all kicked off on January 21st. That's when Torrent Pharmaceuticals sealed the deal on this massive, nearly 12,000 crore rupee acquisition. And just look at the chart. The market's reaction was immediate. Trading volumes shot up 3 times because the entire story changed overnight. JB Chemicals was no longer just a simple growth play. It suddenly became a high-stakes bet on the success of this merger, a classic merger arbitrage situation. And this right here is the most important part of that story, the changing of the guard. For the last 5 years, under the private equity firm KKR, with Nikhil Chopra as CEO, the game was all about one thing: unlocking value. Now, with Chopra leaving on March 31st and Torrent's own Aman Mehta taking over, the whole playbook is flipping. We're shifting from an era of value unlock to an era of synergistic integration. Okay, so why all the excitement? What has the market feeling so optimistic? Let's unpack the bull case. Really, it all comes down to the incredible foundation that KKR already built and the massive synergies that Torrent can now build right on top of it. You've got to understand, under KKR, JB Chemicals went from this kind of sleepy, family-run company to an absolute high-margin machine. They did this by zeroing in on chronic therapies, which expanded their gross margins by 200 basis points. That's a full 2%. And they got their medical reps way more productive. That surge from 22% to almost 29% margins, that's the super profitable foundation that Torrent gets to inherit. Now, the engine room of the whole company is really powered by 4 incredibly strong brands in the chronic space. We're talking Silicar, Rantac, Metrogel, and Nicardia. As you can see from the data, these brands aren't just doing well, they are consistently growing faster than the entire Indian pharmaceutical market, the IPM, by a solid 2 to 3%. That's real market share they're grabbing, and it's getting an extra boost from recent price hikes of about 7%. But the story doesn't stop with the domestic brands. The contract development and manufacturing business, or CDMO, is a whole other growth engine. Their specialty in medicated lozenges gives them a really solid order book, and management is actually guiding for a strong 10 to 12% compound annual growth rate all the way through fiscal year 27. The plan now is to use Torrent's massive network to really ramp up exports into the US and Europe, which are, huge markets. Now, this is the part of the deal that's really getting investors fired up, the 51 to 100 share swap ratio. What this does is it basically ties JB Chemicals' fate directly to the much, much larger Torrent conglomerate. And what's the result? Well, you're creating a brand new domestic leader in chronic therapies. This combined company will have the scale and the depth to seriously compete with the biggest players out there, like Sun Pharma. But hey, it's not all sunshine and roses, right? No deal is perfect. We have to look at the other side of the argument. So let's switch gears and talk about the bear case, which really boils down to 2 main worries: a sky-high valuation and the risks of putting these 2 companies together. The single biggest red flag for the bears is right here. At a price-to-earnings ratio of around 40, you are paying a pretty penny for this stock. It's trading way above its own history and what its peers are trading at. A valuation this rich leaves zero room for error. I mean, any little hiccup, let's say the integration gets messy and slows down that MR productivity we talked about, or maybe the big debt pile Torrent took on starts to bite, any of that could really put this stock price to the test. Okay, so you've got this powerful bull case on one side and some very real risks on the other. So where does that leave us? Let's try to put it all together to understand what the path forward looks like for this new entity. The general consensus view is that JB Chemicals is going through a massive evolution. It's shifting from being a steady compounder under KKR to becoming a huge consolidation play, and ultimately, a market leader under the Torrent umbrella. With a really strong return on equity forecast of about 22%, the thinking is that this remains a high-quality stock to own. In fact, some might see the current merger-related ups and downs as a good chance to build a position. And this is the endgame. This is why everyone's so focused on this deal. The ultimate goal is to create a company with an absolutely commanding position in the domestic retail pharmacy market. By combining their strengths, especially that deep reach into chronic therapies, the new Torrent JB Powerhouse is expected to have way more pricing power and achieve a level of retail dominance that almost no one else can touch. So finally, let's bring it all back to the stock price itself. The technical chart is telling a very bullish story. You can see the stock has been respecting a clear uptrend since 2020, and now it's breaking out past its highs from August 2024. So, the multi-billion-dollar question is this: can the new, stronger, consolidated fundamentals of this Torrent JB powerhouse justify the stock continuing to make higher highs? Right now, the market is betting a big yes. But as always, only time will tell.